This is an analysis from Alpha Business Media. Today, we're deconstructing the economic machinery behind a quiet but powerful agricultural revolution that's happening right now in the mid-hills of Nepal. We're seeing a massive shift away from traditional staples towards high-value fruits like kiwi and avocado. And this quote, it absolutely nails it. See, this isn't about traditional farming anymore. A new class of urban, data-driven investors is fundamentally rewriting the rules. They're trading the old certainty of low-margin greens for a calculated, long-term bet on premium produce. So the big question is, why is this happening now? Let's break down the investment thesis.
All right, here's our game plan. We'll start with a core value proposition, then look at the huge market engine driving all of this. After that, we'll dive into the investor playbook, and finally, we'll ask the big question, is this a sustainable boom or a bubble waiting to bust?
Okay, at its heart, the decision to rip out a field of maize to plant a kiwi orchard, well, it's not an emotional one. It's a cold, rational calculation. The entire play is built on a really powerful economic concept. That concept is value density. It's a simple but profound idea. How do you take the same finite piece of land and dramatically increase the revenue it generates? It's about transforming a low-yield asset into a high-performance one. And once you see the numbers, the logic is just undeniable. Just look at this. The difference is staggering. A ropani of land, which is about 5,500 square feet, might pull in 20,000 rupees a year from a crop like maize. Now, that exact same plot of land, once a kiwi orchard is mature, it can bring in more than 250,000 rupees. It's not even in the same ballpark. We're talking about a more than tenfold increase in revenue productivity per unit of land. That kind of differential completely rewrites the financial model for farming in Nepal. But, of course, there's a catch. This only works if you can operate at a commercial scale. So, how are investors actually solving the land problem? Well, since you can't just go out and buy huge connected plots of land, investors have pioneered a new model, land aggregation through long-term leasing. They go into a strategic area, negotiate with hundreds of smallholder farmers, and sign these 30 to 40-year lease agreements. This gives farmers a stable, passive income and allows the investors to build the massive commercial-scale orchards they need. This process alone creates a huge barrier to entry for competitors. So the supply-side numbers are obviously very strong, but the real engine, the gravitational pull that's fueling this whole boom, is the massive and very specific demand coming from just south of the border. The strategy isn't to compete with India, it's to complement it. And the core strategy here is a concept called agroclimatic arbitrage. Now, that's a fancy term, but the idea is actually very simple. Nepal's temperate mid-hills can grow crops that need chilling hours, like kiwis. The hot plains of India simply can't provide that climate. And this difference creates a massive, natural, and very lucrative market opportunity. Think about it. Before this, India's growing demand for these fruits was met by expensive imports from places like New Zealand. But Nepal's proximity? It's an absolute game changer. Shipping time drops from weeks to less than 2 days. The cost structure is just completely different. No overseas shipping, lower tariffs, and of course, the product is significantly fresher. This isn't just a small improvement, it's a massive strategic advantage. Okay, so the opportunity is crystal clear. But let's be real, agriculture is inherently risky. You've got weather, pests, disease. So the smart money flowing into this space isn't just ignoring those risks. No, they're systematically de-risking the entire operation with a very modern playbook. This proactive approach is what's transforming orchard agribusiness from what used to be a gamble into a calculated, investable asset class. And it really rests on 3 key pillars. First up, the ag tech stack. We are seeing some seriously sophisticated technology being deployed. You've got Israeli-designed drip irrigation, which basically decouples the orchards from unpredictable monsoon rains. You've got drones and sensors providing a constant stream of data for predictive maintenance. This is all about using technology as an insurance policy against failure. Second, you need the right kind of money. A new orchard takes 5 to 7 years to start generating real revenue. That pretty much excludes your typical bank financing. So this whole sector is being fueled by what's called patient capital, investment from family offices and specialized funds that are willing to wait for that payoff in exchange for stable, annuity-like cash flows for the next 2 or 3 decades. And third, they use a portfolio approach. The really sophisticated players aren't just betting the farm on a single location. They are building a geographically diverse portfolio of orchards spread across different districts and provinces. So if a hailstorm or a pest outbreak hits one valley, it doesn't wipe out the entire investment. It makes the whole thing far more resilient.
So, with all this momentum, where is this sector actually heading? The truth is, it's at a really critical inflection point, and there are two very different futures ahead.
In the best-case scenario, you get supportive government policy, you get investment in critical infrastructure like roads and cold storage, and you could create a booming Himalayan fruit belt. But in the stagnation scenario, you get bureaucratic roadblocks and neglect, and this whole opportunity could just become another cautionary tale. The path forward is absolutely not guaranteed.
But the most dangerous threat here isn't bad policy or a new pest. It's actually the risk of the sector's own success. The high profits of the early pioneers are going to attract a wave of copycat investors, many of whom won't have the technical expertise. And that could lead to a glut of low-grade fruit flooding the market in 5 to 7 years. This could completely destroy Brand Nepal's reputation before it even has a chance to get off the ground. And that leaves us with the final critical question. The race is on. But the race isn't just to plant more trees. It's an urgent race to establish and enforce national standards for quality. Can Nepal build a premium, trusted brand for its produce before a wave of mediocrity turns this potential golden harvest into a bitter one for everyone? The answer to that question is going to define the next chapter of its economy.